Now comes the exception that in spite of the fact that during the assessment proceedings, additions are made, if certain conditions are satisfied, then the additions made will not be regarded as underreported income. What are these situations? So there are clauses A to E, 5 clauses, which lay down situations in which, although addition is made during the course of assessment, still the addition made will not be regarded as underreported income. Let us look at these situations one by one. First situation is the amount of income in respect of which the assessee offers an explanation and the assessing officer or CIT or principal CIT or CIT appeals is satisfied that the explanation is bona fide and the assessee has disclosed all material facts to substantiate the explanation offered. Again, what is a situation when addition is made in the income, but assessee offers an explanation to AO or CIT appeals? That explanation is bona fide and the assessee has disclosed all material facts to substantiate the explanation offered. Let me give one example. Take the case of a cooperative society, say a cooperative housing society, which earned income from investment made in a cooperative bank. Now, in the income and expenditure account, which was filed with the return of income, on the credit side, interest on investment made in cooperative bank is clearly specified. In the computation of income, it is properly disclosed that interest was received from deposits made with cooperative banks. So the second condition, the assessee has disclosed all material facts, is satisfied. In income and expenditure account and in return of income, in computation, it is clearly specified interest was received from a cooperative bank. Now, with reference to this interest, the cooperative society claimed deduction under section 80P, subsection 2, clause D, 80P2D, where a cooperative society makes investment in another cooperative society. The interest income is deductible under section 80P2D. But the assessing officer takes the view that a cooperative bank is not a cooperative society. The cooperative society produces a certificate obtained from cooperative bank, which certificate indicates that this cooperative bank was registered under the Cooperative Societies Act. But AO or CIT appeals takes the view that cooperative bank cannot be regarded as cooperative society and therefore deduction under 80P2D is not allowable. So the assessing officer or CIT appeals makes addition of this deduction which assessee has claimed, cooperative society has claimed, but according to him it is not allowable. Now he makes additions, levies tax. Is this addition covered by this exception? Let us look at this, where the assessee offers an explanation which is bona fide. Assessee explains that I am producing a certificate obtained from cooperative bank, which indicates that it is a cooperative society registered under Cooperative Societies Act. So I have taken I have bona fide taken the view that cooperative bank is cooperative society. Your view is different, but my explanation is also bona fide. And the fact that the interest was received from cooperative bank is clearly disclosed in the return as well as income and expenditure account. So both these conditions are satisfied and therefore penalty under section 270A should not be levied, and this addition made on account of not allowing deduction under 80P2D cannot be regarded as underreported income. The contention of the SSC would be correct and no penalty can be levied on such an addition. So this is an example. There could be many such examples where SSC has declared in the return all material facts, or during the course of assessment, he has declared all material facts, and he has offered explanation as to why certain deduction was claimed or why certain receipt was not offered for tax. In such a case, although addition is made because of difference of opinion, it will not be regarded as underreported income. Take another situation. Clause B. The amount of underreported income is determined on the basis of an estimate. If the accounts are correct and complete to the satisfaction of the assessing officer, CIT appeals, CIT or principal CIT. But the method employed is such that the income cannot properly be deduced therefrom. Again, when you look at this language, you may start wondering, what is the situation in which income is estimated? So let me again give a practical example. Take the case of a building contractor. He has undertaken, say, 5 contracts. They are all under completion. He follows percentage of completion method. And we are aware that under percentage of completion method, the income on incomplete projects is required to be estimated. There is an element of estimate. The SSC, the contractor himself, estimated income on each incomplete contract and declared it. The method of accounting he has employed is percentage of completion method. So where income cannot be exactly deduced, because here element of estimate goes into computation of income. So if suppose SSC declares 50 lakhs income from 5 projects, which are still incomplete, they are under construction, but the assessing officer makes addition of 20 lakhs, his estimate is 70 lakhs, and he levies tax on it. This is a case covered by this exception, that SSC has employed correct method of accounting, but the method is such where estimate is required to be made, and this estimate is always subjective. If you give this estimate to be done by 3 or 4 different persons, they may arrive at 3 or 4 different figures. In such a situation, SSC cannot be said to have underreported income. So in spite of the addition made, which the SSC may challenge in appeal or may not challenge in appeal, but still it will not be regarded as underreported income. Let us take the next case. Situation C. The amount of underreported income is determined on the basis of an estimate if the SSC has on its own estimated a lower amount of addition or disallowance on the same issue and has included such amount in the computation of his income and has disclosed all the facts material to the addition or disallowance. Again, let me explain this with an example. An SSC runs business, and in the profit and loss account, motor car expenses and motor car repair expenses are debited. Motor car is used for the purpose of business, It is also used for personal purposes. And SSE has made an estimate that 25% of the use of the car is for personal purpose and 75% is for business purpose. Suppose the motor car running expenses was 1 lakh, motor car repair expenses was 1,50,000, and the SSE disallows 25% of this expenditure, that is 37,500. In the course of assessment, the assessing officer comes to the conclusion that based on explanation given, not 25%, but 55% of the use of the car is for personal purpose. So out of 1.5 lakhs, the assessing officer disallows 75,000 as against 37,500 disallowed by the SSE. Again, see, this disallowance is based on an estimate. SSE himself estimated and disallowed certain amount. During assessment, assessing officer disallowed higher amount. He estimated higher amount. When disallowance is made on the basis of estimate, and SSE had already made such estimate, the disallowance made will not be regarded as underreported income. So this is another exception to this situation, that where addition is made, addition is always underreported income. It is not so. Fourth situation, we know that where transfer pricing provisions are applicable, the SSE is required to maintain documents under section 92D. He is required to compute arm's length price. And if there is a difference between actual transaction price and arm's length price, he is supposed to make disallowance of the difference. If the SSE has maintained documents as prescribed under section 92D, and he has also made disallowance by computing arm's length price, suppose subsequently during assessment, the transfer pricing officer computes a different arm's length price and makes addition to the income declared by the SSE. Such addition will not be regarded as underreported income, because after all, again, in transfer pricing provisions, if documents are maintained, arm's length price is determined as per one of the prescribed methods. There could be difference of opinion on selection of comparables, and transfer pricing officer may come out with a different arm's length price. This is also subjective, and therefore an exception is provided that in such situation, if addition is made, such addition will not be regarded as underreported income. And lastly, if the amount of undisclosed income is referred to in section 271 AAB, it will not be regarded as underreported income under this section. So what is this undisclosed income? In section 271 AAB, where in the premises of an SSE, search takes place and assessment is done post-search. It is called a search assessment. And when additions are made in the course of such search assessment, penalty is leviable under section 271 AAB and not under section 270A. There are separate provisions for computing reported income there, and there are separate provisions for levy of penalty. So section 270A will not apply. The concept of underreported income is not applicable to assessment made post-search. So these are the 5 exceptions where, in spite of the additions made, such income will not be regarded as underreported income. and one needs to argue properly where penalty proceedings are initiated by the officer and a so cause notice is issued. One can make assessment of the case and find out whether the case falls within exceptions or not. And if it falls within exceptions, one should argue and uh, plead before the officer that this addition should not be regarded as underreported income.